Hi, Lee Phillips here again. Let me talk to you about selling your personal residence. And when you go to sell your personal residence, it has some tax benefits. If you've lived in it 2 out of the last 5 years, and they don't have to be consecutive days that you live in it, but at least 700 and whatever it is days out of the last 2 years, then you can sell your personal residence and you can get a tax benefit. That's $250,000 for a single, or if you're filing jointly, it's $500,000. That's a good tax benefit. You get to just take $500,000 in profit out of the sale of your personal residence, no tax. It's a capital gains exemption. And so it's a big deal, guys. There's a catch, though. The catch is you have to prove what your basis in the residence is. Okay, the capital gains are the difference between the basis and the sales price. What is this difference? Well, I know what you sold it for. That's easy. What did you buy it for? You bought it 30 years ago. You can't even tell me. Oh yeah, you kind of know what you paid for it, but you don't have any paperwork to show that. And you've remodeled, you put the basement in, you've put new roof on, you've extended the kitchen, you've done all of this stuff over the years. Those are all improvements. You didn't get a tax deduction for putting those in, so you didn't keep the receipts. No, you need to keep the receipts because that adds to your basis in this personal residence that you're selling. So we need to establish the basis. If you can't establish the basis with numbers, with receipts, with paperwork, then the IRS says your basis is 0. So it's a big deal, guys. You need to think. And how long do I keep them? You keep them until 5 years after you sell the place. Because they've got 3 years to audit. That's 3 years from when you file. You could get an extension. It's basically 5 years. That's Lee's rule, okay? But you keep the receipts, you show the basis, and the adjusted basis is the price, plus all of the stuff that you've put into the residence that wouldn't be considered just a repair. And we have a full taxation of real estate thing that we go through and show you what repairs versus improvements. You don't need to worry about that right now. But you need to keep track of everything because that will add to the basis. And that's money in your pocket, guys. If you can increase the basis to the max and then take this $250,000 or this $500,000 tax-free, basically, out of the sale of your personal residence. This is Lee Phillips. Get my 10 tax tactics. We go into stuff like this. Not this one specifically, but you ought to be able to make an extra take-home pay, spend an extra 10, 15, 20 grand a year if you're making $100,000, $200,000. The goal is to cut your taxes by 10 to 20%. What does that put in your pocket extra? That's the 10 tax tactics. Just click the link. It's free. Don't worry about it. We don't sell your list, our list. We don't sell you either. And it's really easy. Don't forget to subscribe. We appreciate all of you listening in, and give us the thumbs up or whatever you do out there in the cyberspace. But it's good to be with you. Lee Phillips talking about the sale of a personal residence.